Karen Wilson, you've been Bruegel's leader in research on venture capital investment in Europe. Tell us a little bit about today's event and some of the key discussion points.
Today we had a workshop here at Bruegel focused on removing barriers to venture capital in Europe. We know that entrepreneurship is critical for innovation and growth, and of course at this time we need innovation and growth more than ever in Europe. And so these young innovative firms, they need financing. And to really grow and scale, they need more than bank loans, they actually need equity financing. And so venture capital can play a very important role. But we've seen through data and research that we've done and that other organizations also have done that there's a gap between investment in venture capital in Europe and in the US, and it's a large gap. It's typically been the last decade between 20 and 25%, and this is a huge issue. But it's not just the gap in terms of investment. Also in Europe, we're giving money, smaller amounts of money to more companies. So there's a lot of fragmentation in the market. Instead of giving a few firms the money they need to really scale and grow, we're giving a little bit of money to a lot of people, and this is part of the problem. There's fragmentation on many levels in Europe. There's fragmentation in terms of regulation, all the different rules in the different 27 EU member countries, but also fragmentation in terms of the funding and in terms of culture and many other issues. So these were some of the things that we discussed today. Also, for venture capital, it's very important to have vibrant exit markets. And unfortunately, the exit markets have been closing over the last 5 years during the financial crisis. It's been much harder for companies to do an IPO, which of course is usually the best exit to have, and or even to do a trade sale through M&A to be bought by another company. And we see from EFCA data from 2011 that trade sales are 20% of exits in the European market, and IPOs are only 7%. So this is really an issue because for the whole venture capital model to work, the exit markets need to be vibrant. And what we see is that many of Europe's promising companies, promising young companies, end up being encouraged either by US venture capitalists or by European venture capitalists to move to the US and to relocate there and then to list on the US exchange. And so this is an issue, or to be bought by a US company. So this is an issue that we also need to address in Europe. There's also the whole issue of the regulatory environment. Things like bankruptcy law make a big difference. If there's a real penalty to failing, then people won't be willing to try. And already in Europe, we do have a culture of a fear of failure. And so it's not just a fear of failure, but it's actually a real penalty of failing in many countries if we can't address bankruptcy law. The other issue is our labor laws. If it's hard for young firms that are trying to grow to hire and fire people as they are going through different growth phases, then they're not going to hire them and grow in the first place. So regulations on labor laws need to be adjusted as well. Other issues include, especially in the ICT sector, which is one of the fast-growing areas for entrepreneurship, ICT and internet, issues like copyright protection and data protection and privacy. These are really important issues. And the problem in Europe is that the regulations are just so hard to understand that there's a perception, even if it's not a reality, that the barriers, the regulatory barriers, are too high in Europe or that they're too fragmented. So one of the things coming out of the discussion today is that Europe should address some of these regulations, not only address the regulations, but also address the awareness of the regulation, and that stability of regulation is really important, that investors and entrepreneurs understand what the environment is today and how they can operate, and also what it will be in the future, and therefore what their risk is going forward. There's enough risk for an entrepreneur or an investor in terms of the business risk, but we need to reduce some of the regulatory risk and some of these other risks that could help encourage more entrepreneurship. So it's important to look at the financing available and also to look at the regulatory framework, the framework conditions. But it's also very important, and this came out very highly in the discussions today, to look at the entrepreneurial ecosystem. It's often the problem is not on the supply side, but it's on the demand side. We need to change the culture and the mindset in Europe. We need to encourage more young people to want to be entrepreneurs. And this needs to start in the educational system at a young age, going all the way through the education system. We need to encourage people to have the ambition to grow and scale. And many entrepreneurs think about creating their own small business, but they don't think about growing across borders because it seems too complicated. So we have to really give the inspiration, the ambition for young people to build these high-growth firms. And for that, we need more role models as well of successful European entrepreneurs, and we do have many of them who have done it, who have made it, and put those role models in front of young people. The other thing is we have great innovation in Europe, but we have to go the next step in terms of commercializing that innovation and getting it out of the universities and getting it into the marketplace.
At the workshop today, we explained about the report we've just published called Unchaining Investment, which looks at the performance gap between UK and US venture capital funds. We've looked in some detail at the gap and the possible causes of it through the numbers on VC performance, but also by speaking to investors about what their perceptions are of the causes of the gap in performance. We interviewed about 25 investors and got their views on regulation and other barriers that might exist to US investment into Europe and into the UK. Their general view is that things are improving, and we can see from the numbers that performance is improving in both the US and in Europe, but also that the gap is widening because the US is improving faster. When it comes to regulation, most of the investors said that it was not top of mind for them when they were making their investment decisions, but that the problems with complex regulation, with fragmentation, or with uncertain regulation can cause them to either avoid an area of investment or to raise the bar so that an investment has to be exceptionally good before they'll consider investing.
Well, the EIT is most likely the first player in the European innovation arena which really tries to integrate all the players of the so-called innovation triangle. That's business, research and education. And we put into the center the entrepreneur. While this occurs very naturally in the United States, let's say in an area like in Boston or in San Francisco, we have in Europe, in silos, all these players. We have good universities, good educational institutes, good business schools, top-class large corporations, smaller companies, even a little bit of venture industry. But to a given topic, they are rarely integrated and bringing also players together. So students who study today, let's say medicine or technology, they are only fostered by professors, but they really never mind to meet, let's say, somebody from industry or somebody from the investment arena, or learning how to write a business plan, or to see that an innovation needs a fresh, good idea, but also ownership and accountability. It's somebody that's mine, I carry it forward, I set up a company. So we have a lack of entrepreneurs in Europe, and the EIT in fostering such ecosystems is trying to to crank out a next generation of students setting up companies, but also educating people when they go in big corporations, become so-called intrapreneurs, and changing within classical companies the paradigm of innovation. So to this end, we have been, with only 300 million euros, seeding into those first three knowledge and innovation communities. I call them innovation factories. And we really could show with only 25% of seed money, you can get a counter-financing of industry, other investors like communities or venture capital to counter-finance the seed money we're giving. So since the topic today of our discussion was how could we better foster venture capital in Europe, and also realizing that venture capital is a very pivotal player of innovation, extremely underestimated. We always think it's only Nobel Prize laureates. We always think these are big companies like Siemens or Nokia, but we have to realize in the end, these are people or groups of people who bet their money on the success of innovation. And it also means risk. You will lose some and you will win some. And good venture funds, they win totally, but they also do this by the virtue of failing so and so many times in investing in companies which do not succeed. So one of our take-home lessons, which I found was greatly organized today, was let's really encourage the Commission, I think, to see what are the 5 largest impediments that venture industry is so rare in Europe. And what are the 5 best incentive structures we could recommend to the member states or implement in the member states to make venture capital to coming to Europe or to stay in Europe? Even this is a problem. And in addition, let's say taxpayers' money, because the EC is in the end taxpayer, not just doing on the philosophy of subsidy or research grants in innovation. Let's do what we do at the EIT. Let's take it as a smart investment, with, as I was, any €1 coming from a member state or from the Commission to foster venture capital in Europe should be really amplified by a factor 3 or 4 in real private capital going into innovation.